Good morning and welcome to OSU Income Tax Schools and Purdue Income Tax Schools Farmer and Farmland Owner webinar for 2023. And we are glad you're with us. I can't believe it's been a year since we've been here at our last Farmer and Farmland Owner webinar. It seems like it's flown by and it's almost Christmas. So it's closing in on the end of the year as well. So what that means typically for many of you out there, and us included, is some last minute tax planning. So we're going to talk about a number of things tax related. Not all of them are going to be specifically tax, but some of them are going to relate to some other issues that are perhaps tax adjacent. So here is our agenda for today. And I know normally our Farm Office Live is a 1.5 hour webinar monthly, but we've expanded that today. And this is our special tax edition that we do each year with Purdue. Thankfully, we have a nice partnership with Purdue University. And so you can see there how it's laid out. And we've got 4 of us as instructors for today. So that you can read and take a look through. We're going to touch on each of these issues. Here's our set of instructors. My name is Barry Ward. I'm the director of OSU Income Tax Schools. And I want to introduce my colleagues today. Dave Marison, professor and field specialist in farm management, is often on these Farm Office Live webinars and often is the one that's introducing folks, but I'm taking a turn today. We're very happy to have Dr. Michael Langemeyer, Associate Director, Center for Commercial Agriculture, and Professor at the Department of Ag Economics with Purdue University. And last but not least, Jeff Lewis, who's an attorney, program coordinator with OSU Income Tax Schools, and my right-hand man in working with tax schools and tax education throughout the year. So all 4 of us are going to be touching base with you here this morning. So, okay, in terms of interacting with us, we would prefer any questions that you might have, subject matter questions, that you upload those questions into the question and answer feature that you see there at the bottom of your webinar screen. Okay, so if you have any questions, if you have just a comment or a technical issue perhaps, or something related to websites, finding information, you can throw that up in the chat feature that we can then address. But any subject matter questions, and we're going to try to address those questions as we go through this morning. We may not get to all of them, but we'll do our best. And you can see there at the link at the bottom, that's the way to access the information for today as far as the slides, a PDF of the slides. And Jeff also dropped that link into the chat, so you can access that as well. Okay. So, well, that's, I think, all the housekeeping items. So we're ready to dive in here. And we're going to start first with just a brief discussion on the farm economy as far as what it was in 2023, mainly just trying to set the stage as far as tax planning. Most of you out there that are with us are already pretty well aware of what your own situation is like, how you did tax planning for this past year, and how you might then gauge your prospects for 24 as you evaluate how much income, as far as cash basis taxpayers, how much income that you might try to keep in 23 and how much you might push into 24. So as we look at the farm income in terms of all the different sectors in the farm community, you know, I've kind of cobbled this together, and David and I have had some discussions on this, and we've included this in our discussion in our professional tax schools in the last month and a half, trying to relate this to our tax professionals. Okay, we've got a little bit of a slide change there. There we go. Okay, so our farm income, as far as what we're looking at there, is we have, first of all, crops. Okay, we take a look at crop income there on the left, and we do have a little bit of a menu showing up there in the center, just so you know, David.
Okay, I'm going to work on this.
Okay, so generally speaking, now this is not for every farmer, but in the Eastern Corn Belt, Indiana and Ohio included, there's been relatively high net farm incomes in 21 and 22, pretty good prices, fairly good yields across most of that area. And, one of the things that we've also seen is high prices, trending lower in 23, perhaps even trending still lower in 24. Fairly large global corn stocks that are weighing on those crop prices and some decent weather in South America. So what does that then mean for livestock producers? Because typically we're looking at kind of two sides of the coin here. And we're seeing on the other side of the coin a little bit of fortunes perhaps changing for the better as feed costs are trending a little bit lower in 23 and likely lower still in 24 if this trend continues, meaning lower feed costs for our folks out there that are feeding livestock and poultry. One thing that we've seen showing up here in this past year especially is fairly high cow-calf incomes. At least by some estimates, we've got the smallest beef herd in the U.S. since 1962, which is really putting a lot of upward pressure on those feeder animals as they're going into these feedlots. Finishing cattle, we don't have a tremendous finishing cattle industry in either Ohio or Indiana. But we do have some, and those incomes have been mixed, mainly because they've had to pay such a high premium, high price for those feeder animals that are entering the feedlot. But those cattle prices remain high. Swine profits, we've got a lot of industry in both Ohio and Indiana. We're mainly looking at highly integrated sectors there, and those profits have been marginal, probably in 23, possibly improving in 24. As we look at dairy, that's been up and down. We've seen some higher milk prices in certain sections of 23 that have allowed for some profitability. The main problem in the entire milk sector, the dairy sector, has been not necessarily over increase in numbers, but the milk per cow has been increasing to the point where their efficiency has been kind of their own worst enemy. But there's been some opportunity for profitability. Perhaps the milk price will increase, but most of the industry pundits are looking at milk prices to be relatively flat into 24. Poultry and egg prices, boy, this has been an up and down roller coaster over the last 2 or 3 years. And we're really looking at whether or not avian influenza is going to be a factor, and it has been. We had to euthanize several 100,000 birds here just west of Columbus in the past few months. So that is going to continue to be a key feature in the supply and demand fundamentals of both poultry and eggs globally, and will somewhat influence those prices and profitability in that sector. So a mixed bag as we look at the entire sector. And I know this is a very shallow look, but as you look in terms of those taxes that you have to pay and trying to figure out whether or not you may have higher incomes this next year versus this year, well, that's something that you each need to consider on your own farm. Okay, so now I'm going to turn it over to David. And David, you can start sharing.
Yeah, I'm fixing something really quick, and I assume you can see the slides now.
Yes,
Sorry about that. I was on a little delay there with my mouse, and if it's Ag Issues Tax webinar, that I'm going to screw something up technology-wise, because that's kind of an annual event with me.
Not a big deal. So you can continue this discussion on farm income, and it's all yours.
Great. As just thankful to be here with Barry and Jeff, and of course our friend from Purdue, Michael Langemeyer, just to talk about ag taxes with you. Just to delve a little bit more, just to show you some added value to what Barry was just talking about. As you look at the farm sector income, it's forecasted to fall as we close out 2023. Of course, the final numbers will come through, but we reached record highs in 2022. But you can see net farm income is predicted to be down by about $41.7 billion or that's about a 23% decrease from 2022. Now, as we look at the crop receipts forecasted for 2023, you can see those across the screen. In total, our cash receipts are forecasted at $267 billion for 2023, which again is a 4% decrease from 2022. And you can see that corn receipts expected to fall by 6%, soybeans expected to fall by just under 9%, and wheat forecasted to increase just slightly. And then receipts, which is not for hay, which are not shown on this screen, they actually are projected to be up 7.4%, or just under $1 billion from 22 to 23. Now, when we look at our animal side of the equation, again, the cash receipts are expected to decrease by 4.6%, or 11.9 billion from 22 to 2023. Now, and Barry showed some of the factors that are in play there. One of the things, of course, that we're going to watch as we move forward is the poultry industry, because of some of the avian influenza that is happening and occurring, especially here in the state of Ohio. As you look at production expenses, I think most procrastinators, those that predict things, right? That production expenses are forecasted to increase by just about 7% from 2022 to 2023. And as Barry was mentioning, that trend continues as we move into the new year in 2024. And then you can see just a quick slide on just some of the differences where we're going to, they're predicting increases in our input side, whether that's feed, labor. I think it's no surprise that interest is probably, as a percentage basis, what is increasing the most as far as increases to our costs for the new year. And you can see the two that they're anticipating a slight decrease from 2022 to 2023 is in the fertilizer as well as in the fuel. As Barry mentioned, we have a whole host of topics that we're going to discuss here today, and I get the pleasure to present the first two. The first is employee versus independent contractor. Then I'll take a quick peek into the estate tax limitations and keeping an eye on what's going to happen there. Our first issue, and this was at our tax schools across Ohio, across Indiana, was talking about the misclassification of employees as independent contractors, and it's increasingly becoming a serious problem facing the broader economy, but also in agricultural businesses, and how we may be misclassifying employees as independent contractors. And I'll give you an example here as we push to the next slide. I hire a few retired farmers to help with grain harvest, to run grain buggies and to haul grain back to our on-farm storage. Can I classify these workers as independent contractors? So a typical thing, and of course, we would desire to have most of those folks that we're hiring to be classified as independent contractors, because bottom line, it's a lot easier on our paperwork. When we think of paperwork, when it comes to federal payroll tax withholding, here in Ohio, the reporting of the Ohio New Hire Reporting Center when we hire an employee. Also, we have thoughts to think about when it comes to worker compensation as well as unemployment compensation and some of the rules. Now, you'll notice there that I have a couple articles and put the couple articles there, and you can again get the whole slide deck at the Farm Office website, and you can download those. And when you do download those, you can access those links and read a couple articles for more information. But essentially, when it comes about how do we classify these folks that we're hiring, are they an employee? Are they an independent contractor? And the first thing that we want to go through here is that there's the definitions as defined by the Internal Revenue Service standard, as well as their standards that are set forth by the Fair Labor Standards Act. So if we first look at the IRS factors, the common test that has been developed by the IRS uses 20 factors to determine whether their workers, their employees, are independent contractors. And they basically fall into the areas of 3 factors. That's behavior control, financial control, and relationship control. So when you look first at, and the IRS has the publication 1779, which you can see the link there on the screen, as far as you want to delve more into the differences. But if you essentially look at the three, the first is the behavior control, basically boils down to the employer having control over the worker and how they accomplish the job or the task that they are doing. So some of the factors could include the type of instruction that's given, the degree of instruction, is there evaluation, is there training. So to sum it up, a person is an employee if the employer controls where or when or how the person works and provides detailed instructions on how the work should be done. And they may provide training as well as feedback. Now, when you jump into the financial control, that looks at who bears the economic benefits and burdens of this workplace relationship. So this basically is focusing on the employee side. So independent contractors typically make significant investments. So that investment could be in equipment that they need to accomplish the jobs that they have. And they are more likely probably have unreimbursed expenses. In fact, they may incur a loss sometimes in a business relationship. So the independent contractor will tend to have a separate place of business. They may do some advertising that they have the ability to work for others. Another sign that they may be an independent contractor is the irregular pay. That is, the compensation is not based on a weekly or biweekly or monthly basis. And then finally, there's the relationship test, and that focuses on how do both sides perceive the relationships. So that could go into the area, is there a written contract? Are there employee benefits? What's the duration in the relationship? What services are provided? For instance, does the worker have paid vacation? Are they getting paid, as I said, about retirement? And is this relationship long term? Bottom line is you have to really delve in and look at all the factors together to see if they're an employee versus an independent contractor. Now, of course, if they are an employee, then the employee must do certain things. And of course, at the top of that list is withholding and deposit income taxes, Social Security taxes, and the Medicare taxes. And they're withholding those from the wages for the employee. And then, of course, then on the backside, the employee must pay the matching portion of the employer portion of Social Security and Medicare. So there are some taxes that will be due, the employee withholding that occurs in an employee relationship versus independent contractor. Now, the IRS does provide guidance. If you're looking for their guidance on whether a person is an employee or an independent contractor, and that comes through the form that you can see there on the right side of the screen, which is the SS-8 form. And you can actually put in for determination whether the person would be classified by the IRS as an employee or are they an independent contractor. As we look at the Fair Labor Standards Act, of course, the Fair Labor Standards Act was put into place to protect workers, as it comes to wage and hour requirements, and also with respect to withholding requirements for their taxes. So the Fair Labor Standards, one of the things, and the reason the issue has been brought forth here this year as we did our tax schools across the nation, was that in 2021, the Department of Labor proposed some new rules when it came to independent contractor status under the Fair Labor Standards Act. So they put some new rules in, and then what happened, they figured out that maybe the rules that they had put in place in 2021 weren't quite appropriate based on case law that was out there. So in 2022, they reversed the rules and proposed new classifications in 2022. Now, at last check, and Jeff, you might be able to mention later about these proposed rules are on the president's desk, President Biden's desk, to be approved. But in these rules, the Department of Labor has proposed rules that the worker to be classified through 6 economic reality tests, which kind of all melt together. So these 6 tests include opportunity for profit or loss dependent on management skill. Secondly, investments by the worker and the employer. Third, the degree of permanence of the work relationship. Fourth, the nature and the degree of the control of the work. Fourth is the extent to which the work that is performed is integral to the employer's business. And then a factor called skill and initiative. All these factors are looked at in combination with one another. So I thought it would be helpful we had some great examples in our tax schools, and I thought it'd be just great to bounce through some of these examples that have come through the tax world, and then how they were ultimately classified. So first, this is looking at the opportunity for profit or loss, and depending on the management skill. So here you have John Davis is a carpenter in Virginia, and last year he advertised his service at a local co-op, and Alice McDonald, who had a farm, saw John's ad and hired him to build a barn and a farm stand. They negotiated the price, and John completed the work. Now, Alice was so pleased with his work, she wanted to hire him to make repairs to her home, as well as to build a fence. Well, John has other jobs, so he must decide whether he wants to build the fence and hire another employee to do the work. So because John is exercising managerial skill that affects his opportunity for profit and loss, in this scenario, John Davis is an independent contractor. Next, investments by the worker and employee. So as we make investments, they look at, is this capital? Is this have an entrepreneurial nature? So is the worker making some investments that would make them an independent contractor versus the business that is making those investments, and then therefore they're an employee? So here you have Jennifer, who is a certified crop advisor. So she's passed the CCA exam, but she advises Southwest Farms, and this is a commercial farming operation, about their agronomic practices. So the farm provides her software, the computer, the office space, and all of Jennifer's equipment and tools. Now, Jennifer will occasionally use some of her own supplies and equipment on the farm, but she has relatively a very small investment in supplies. It's not capital in nature, and she is not offering her services outside the scope of Southwest Farms. So because of this, I think all of you will say that she is an employee. Now, if we took this situation and maybe twisted it a little, the facts maybe could be the same, but she starts marketing her services to other farms. And in fact, most of the other farms that she works with, she has to provide her own equipment and her own office, her own software, her own tools. In fact, she rents an office space. So these sort of investments by Jennifer would indicate, could lead to the fact to have her ruled as an independent contractor, because she is putting the investment in and running this like in a business-like manner. And then one of the next factors is the degree of permanence of the work relationship. And that is the work relationship, is it indefinite in nature, or is there a continuous nature? So a permanent work relationship may include regularly occurring fixed periods of work, such as very seasonal. So this example is really good when it comes to seasonal work. You have Lucas, who's a field worker for Greenfields Production, and they're a specialty crop farm in the Southeast United States. He's worked for the farm for 5 years, and typically the work starts in March with planting and ends in October with harvesting. And Lucas at that time provides labor only for Greenfields, doesn't actively market his services to other farms in the area. This farm provides all the tools, supervises his work. However, in the winter months, Lucas provides handyman services around the community. Even though Lucas does not work for Greenfields Production for the full calendar year, the nature of his work for them suggests that he is an employee of the farm. Now, his handyman work would be as an independent contractor, not as an employee. And then what about nature, degree of control? So this is how much control do we have over some of the things that an employee has to do. So this could include some type of training that they need to take. It could include drug testing. So you have the first example there, which is actually a federal court case out of the Fifth Circuit from 2019. A drilling company required workers at an oil drilling site, regardless of who the workers were, to go through safety training as well as conduct drug testing. When they looked at this, the court found that the training and testing was not controlled because of the nature of the employment at the oil drilling site. So even though the company required to have a safe environment, that the workers go through safety training and that they're drug testing, based on all the factors that were as part of this case, they determined that they were independent contractors. So just because a farm might require some type of training or safety doesn't necessarily mean that they become an employee. For instance, the next example there that you see is what happens if we require a CDL license or a commercial applicator's license, which is held by the individual. That doesn't automatically classify them as independent contractors. In most cases on farms, that would mean they're an employee. And then as work as an integral part, we have our SunGold tomato farm here. They sell tomatoes, the distributors and the farm pay the workers to pick the tomatoes during the harvest season. Because this is a very important part of the farming business, these workers are not independent contractors, they are employees. And then on the flip side, what about SunGold, where they just pay an accountant for accounting services and file their taxes? This accounting service, that is support that's offered to the farm, why it's not critical, it's necessary, but therefore when they hire this person, they're not employees, they are actually an independent contractor. And then finally, Gerald Jackson, this is the skill and initiative factor, which determines whether a worker has to use specialized skills to perform the work and whether those skills are more like a business-like initiative, making them an independent contractor. So in this example, you have Gerald Jackson, who's a highly skilled welder. He provides services for Blue Cow Dairy, repairing equipment and machinery. Gerald also provides welding services for several other businesses, and even though he's technically skilled, he also uses and markets his skill in a manner that is in a very business-like initiative. Because he's doing this for other farms in the area, he becomes an independent contractor. So there's a lot of discussions, as we'll be monitoring as we go forward, about what is happening in the area of the independent contractors versus employees. But again, this new Department of Labor is looking at some of the different scenarios out there to determine whether they're employee or independent contractor. Barry, I see you popped up, which mean you might have a question.
Yeah, I was just going to pose a question, David. You know, we've been talking about this throughout the last month and a half at tax schools, and some things have come up. So you and I both know that lots of small business owners, farmers included, would oftentimes prefer to just 1099 their workers rather than go through all the W-2 process. So you know, they often ask for, where's the risk at? If I'm going to kind of
Right.
push the envelope and go into that gray area and just 1099 them.
And yeah, and that happens a lot, right? And
Yeah.
or even further from that is paying everyone under the table. Well, if they're employees and they're at risk, there's liability risk, especially with disgruntled workers.
Yeah.
Or workers where there may be unfair labor practices that are happening. Of course, there could be, and especially even on the IRS side, there could be fines to the business for not properly withholding the taxes that are required by law if they're an employee. So there could be some worker compensation, worker compensation.
Yep. Yep.
Coverage issues. A lot of in the state of Ohio, not reporting the new hires could be subject to a fine because you're not doing the proper reporting to the new hire system as far as all the things with a new employee. So they're at risk not only for liability if something happens where someone gets hurt,
yes,
but also they could be really subject to some fines for not withholding the taxes that should be done.
Yep. Well, I just wanted to have
Huge
that
area
conversation.
of concern.
Yeah.
Yes.
The injury thing, that especially in farming, you know, even if you hire that part-time person that you think is 1099, really they're probably a W-2 employee. They get injured and you don't have workers' comp at the very least, and you are at risk.
Yeah, very much so. This is, I think it's becoming a higher priority for us to have a lot more discussions in this area for sure.
Agreed.
Yep.
Thanks.
Okay, moving off workers' compensation, just as we want to make sure as we move into 2024 that now's the time to look forward on the estate and gift tax limitation and potential changes that are coming. You know, often when we are doing our farm succession workshops across the state, number one question is, will I lose my farm to the estate tax? Well, as we look at federal estate tax, the annual gift exclusion, so this is just the gift exclusion where I can give anybody else $18,000 per year without the requirement of filling out a gift tax return form. So each of us can give $18,000 to someone else in the year 2024 without having to file some type of form. Now, as a husband and wife, we can take that $18,000, say we want to gift some money or maybe some LLC shares to some of our folks in our family, maybe our sons or daughters. Well, as a husband and wife, that $18,000 will then be times by 2. So 18 then turns into 36,000. But as we look at the federal estate tax limitation, we're almost through 2023. So we're at 12.92 million exclusion for each of us as individuals. You would double that as a married couple. As we move into 2024, the IRS has released the limitations for 2024, which is 13.61 million per individual. As a married couple with our portability, that turns into 27.22 million, which is for Ohio farms, for many of our Indiana neighbors, as a married couple, the $27.22 million. In other words, until it goes over that, you're not going to pay any federal estate tax at that 40% tax rate. Now, as we look towards 2025, the 2024 limitation of 13.6 will be indexed up for inflation. So we'll probably be closer to that $14 million as we move into 2025. But as we move into 2026, and Dr. Langemeier will talk later about some of the changes, the rollbacks that will occur as things will be phased back out of the Tax Cuts and Jobs Act that occurred. Notice what happens to our estate tax limitations. It's going to roll back to $5 million per person in 2026 as we hit January 1st, 2026. Index that for inflation. Probably you can throw out the figure $7 million there. $7 million as an individual or $14 million as a married couple. As I watch the land prices continue to increase across Ohio, across the Midwest, and then we get into some situations where many of our farms, the difference between $14 million and $28 million could make some of our assets when we pass away subject to that federal estate tax. So really, really important. Here's the alarm. In the next 2 years, make sure that you're getting an adequate balance sheet, a state balance sheet together, and having some thoughtful discussions with your ag attorney. So we're going to watch it. Whether that will be, if the rollback will occur or will it not in 2026, your guess is as good as mine when it comes to what Congress will do with respect to this area. But plan for the worst and hope for the best. Also, one of the things, and our friends at Farm Bureau are watching this, about the elimination of the step up in basis for land and machinery has been talked about. Now, Peggy Hall and Robert Moore in our Ag Law and Resource Program do a wonderful job of monitoring everything that's happening and the legislative side, and they're always writing articles on the farmoffice.osu.edu, the Ag Law blog. So we make sure that you're following that blog so you can see as we monitor, we will be giving updates. Another thing that you might want to consider, and I know that you have farm succession workshops for our friends over in Indiana that are attending today, but we do our farm succession and estate planning workshops here across the state of Ohio. In fact, we just held one a week ago over in Salina, Ohio, there in Mercer County. So we do have some coming up. One will be in Lisbon, Ohio, and Columbiana County on January 19th, Urbana on January 26th there in Champaign County, February 2nd in Tiffin, Ohio, up in Seneca County. If you're not close to one of those locations, or maybe you're out of state, or maybe you're even going to Florida for the winter, that's okay, because you can join us on our Zoom webinar series, which is going to be held on the Mondays of February, so February 5th, 12th, 19th, and 26th from 6:30 to 8. For one registration price for that webinar, you can get your whole family enrolled. They'll get the Zoom links, and we'll have a great discussion online. Myself and Robert Moore will be teaching that program. We would encourage you, if you want more information in this area, just go to go.osu.edu/farm succession. And we have some great resources on the Farm Office website, the Planning for the Future of Your Farm bulletin series. We talk about the nursing home dilemma and long-term care costs. And Robert has authored an incredible publication on that that's available there as well. And also behind the scenes, Robert and I have been working on developing the farm asset and resource management spreadsheet, which will allow you to basically summarize your entire estate to have that ready as you go to have those conversations with your attorney. I just want to mention that in the beta testing version right now. And if you want a copy of that spreadsheet for future use, and we'll be doing some training on this, you can sign up for that at go.osu.edu/Excel with farms. And you can go on there, or you can use that attractive QR code there to snap a picture with your phone and go there and just put your name and information, and we'll get that to you. And the last thing that I have before I turn it over to Barry, one of the things that we're really, really excited about is Peggy Hall and Robert Moore put together a proposal for the Ohio Farm Resolution Services. And this is a dispute resolution services is provided. We were one of only 5 or 6 states across the nation that didn't have some type of mediation services that we could offer our producers. Well, they have applied to the United States Department of Agriculture and have been approved to start the Ohio Farm Resolution Services. Now, we're pretty excited about this program because it will be offered through our Ag and Resource Law program. This will help us provide resources and consultation to farms and farm families as they talk about some of the issues that might be causing some issues right now or potential conflicts in the future. For instance, I was out just yesterday meeting with a farm over some of the estate plan and some changes that happened in folks from the family that have left the farm and how that's going to impact the farm in the future. So we're pretty excited about this. We'll do some informal type of education. We also can be able to do some formal court mediation if that occurs, but we're looking at helping in the areas that you see there on the screen, from everything from family communication issues, transition planning, to business entities, zoning, labor use, could be fence law issues, farm lease issues, lender credit type of work, that just helping people solve problems in their businesses. And we will have 4 trained facilitators, mediators of this program, Peggy Hall and myself, as well as Jeff. And then Robert Moore is the leader of this program. So we're excited to have this kicking off here in the state of Ohio. And kudos to Peggy and for Robert for getting the groundwork laid with the United States Department of Agriculture and the Farm Service Agency for bringing that here to the state of Ohio. So kudos for that. More information for that to come. And if you have any questions that you would like to direct me, I'll answer some here behind the scenes as we go. But there's my contact information, my phone number, as well as my email. So with that, Barry, I'm going to turn it over to you to go into the world of beneficial. Something beneficial. I hope it's beneficial, right?
Yeah, we're going to talk about it. Okay, thanks, David. All right, a lot of good information there. So I know if you got questions on that, and I think there's one in the Q&A feature that you can address later, David. So, okay, a lot of good stuff. Let's move on. I'm going to talk. Okay, this is not tax, everyone, but it's going to require some filing. So we thought it was something that was important to discuss as we went through. For those of you who are either farmers or farmland owners, and you may have a special business entity, it's going to require some filing. So we've been talking about this particular subject at length in our tax schools for professionals over the last month and a half. And I think it's been a point of discussion across the country as people start to gear up for this, or at least start to increase their knowledge on this particular topic. Okay, so the beneficial ownership information reporting, BOI is the acronym that we've been using. So if you're not aware, some of you are, beginning on January 1st, many corporations, LLCs, that's the important one for most of you, and other entities created or registered to do business in the United States must report information about their beneficial owners, the persons who ultimately own or control the company. And we have to report this to the U.S. Department of Treasury's Financial Crimes Enforcement Network, or FinCEN for short. So this is not for the IRS. This is a filing to a completely different entity that many of you have never had to deal with in the past. So this is new. It's creating a lot of anxiety, and we're going to talk through it as far as the steps and also the possibility, but it's very, very low, that there may be some changes in legislation that will push this back. But we're getting so close to the time that we're not really going to see anything, or we're not expecting to see anything in legislation that's going to change the necessity for you to complete this reporting, this filing. Okay, so the beneficial ownership information reporting, it's a part of the Corporate Transparency Act. Now, this act was passed as a bipartisan piece of legislation back in December of 2020. Okay, so this law requires companies in the U.S. to report to the FinCEN, the beneficial owners, and the company applicants. The Corporate Transparency Act. Okay, so what is it designed to do? It's designed to ban the anonymous shell companies, or at least scrutinize those that criminals and certain foreign officials use to hide and move corrupt proceeds and other illicit financing. So that's the goal of this Corporate Transparency Act, is to root out all of those bad actors. Okay, the regulations, the time frame for filing. The requirements for filing are beginning in January 1st of 2024. Entities, including LLCs, that are required to file if they were created before January 1st of this next year. So if you're already in existence, you have 1 year to file on the FinCEN portal, okay, up till January 1st of 2025. Beginning January 1st of this next year, if you're a new entity created during this next year, you have 90 calendar days to file. So a little bit more restrictive there for new entities that are filing with their respective secretaries of state in this next calendar period. So it was 30 days. There was some action taken to increase that period, that window, to 90 days. So if you're going to create a new entity, LLC, partnership through the Secretary of State, or any corporation, you're going to have 90 days to be able to file with FinCEN all of this information that's required. Reporting companies will have 30 days to report changes. Okay, so if you have any number of changes, and I'm going to relate those changes here in just a little bit as far as what those might be, you only have that 30-day window. This is what's got everybody a little bit worked up. Well, besides the fact that you still have to, that you're going to have to do this filing for the first time. You're only going to have 30 days to report those changes. So this is a little bit of a tight window, and it's a lot of people concerned. So what are some examples of changes? I mentioned this is one of the issues that's creating some anxiety. Some examples of changes in the original reporting would include the beneficial owner, simply a change of address. You may have an ownership change where someone's selling out, or there's a death in those stocks, or that ownership of that LLC component is going to pass to the next generation. And as I mentioned, the death of an owner. So any of these kinds of changes are going to create a situation where you have to update that filing with FinCEN in 30 days. Specific entities, who is subject to reporting. This is a review of some of the things that I've already discussed, but there are some specific exclusions that I'll talk about here in the next slide or two. But those that have filed as corporations, limited liability partnerships, business trusts, limited partnerships, limited liability limited partnerships, and LLCs. They all must file this report. So in other words, anybody that's filed or set up an entity through the Ohio Secretary of State or I should have done my homework, but I'm going to guess it's the Secretary of State in Indiana as well. If you have a business entity set up through these particular state agencies, you're going to be required to file this FinCEN report. Even if, and we've had this question throughout our tax schools as well, even if you're a single member LLC or a disregarded entity in tax parlance, if you are just a single member LLC, you're still required to file this FinCEN report. Okay, so there are some exclusions. An entity must meet all of these particular conditions to be excluded from this filing this beneficial ownership information report. If you employ more than 20 people, you have revenue of more than 5 million, and you have a physical presence in the U.S. So the thinking here is that you're going to be scrutinized in other ways outside of this BOI reporting. So these larger entities with a number of employees, there's going to be other ways to examine those owners of these companies. Other exempt entities include charitable organizations, including religious and nonprofits. FinCEN states that other types of legal entities, including certain trusts, are excluded, mainly because they haven't filed any documents with their respective secretaries of state or similar office in those states. So there's not that particular relationship set up. So those trusts in these situations would not be required to file. So what is to be reported? Okay, information to be reported is names, dates of birth, and I want to thank John Lawrence. I'm adapting a lot of his material. John is one of our instructors through our tax schools, so I want to shout out to John for allowing me to adapt his materials for this presentation. The information to be reported is the name, the date of birth, and an address of each beneficial owner, a unique identification number from a driver's license, a passport, or other government identification, the issuing jurisdiction of that acceptable identification document, and the image of the document. Okay, so you can see it's fairly extensive. What's required? If an individual provides the above information directly to FinCEN, the individual may obtain a FinCEN identifier. So there's a way to somewhat circumnavigate sharing this directly in the report, but you also have to report that to FinCEN to get that FinCEN identifier. It is a little bit of a maybe more of a safety protocol for some of those folks, but in the end, you're reporting that all to FinCEN. So there may not be a whole lot of safety that is actually gained. There are penalties. Okay, so this is something that you're all going to want to do, assuming that we continue to have to do this and there's not legislation to change this, but all indications are that we are going to be having to report these. If you have an entity, and many of you have LLCs set up, you're going to have to report these or face these penalties, both civil and criminal. $500 a day penalty for not reporting in those appropriate windows when you're required to, and criminal fines up to $10,000 and/or imprisonment. So significant. So the current status, the FinCEN is currently constructing the reporting system. Their online platform is not ready to go yet. We've been checking. So the beneficial ownership secure system that's going to be set up to collect and store these beneficial ownership reports. The system is not yet available. No reports will be accepted before January 1st of 2024. So we're still waiting in terms of whether or not we can go on that. Each entity is responsible. So some of you perhaps are going to take this on yourself and do it yourself. Some of you are going to be seeking assistance in filing, you're going to be looking to your attorney that perhaps helped you set up the entity, or some of you are going to your tax professionals because those are the folks that do a lot of other filings for you. There's a difference of opinion in the tax community as far as whether or not they're going to be filing these for their clients. Some are going to perhaps do it, of course, with a charge, and some are going to shy away, looking at this as the potential to increase their risk exposure. Many of your tax professionals have been in contact with their own malpractice insurance, their errors and omissions insurance, and those companies are, in many cases, indicating to those tax professionals to stay away from this type of reporting, not even providing any cover, not even providing any insurance for these tax professionals. So you're going to, I think, see a mixed bag of acceptance or declining clients to do this kind of filing. So you may want to check with your tax professional if you are thinking of them as the logical go-to, because they may not be engaging in this kind of filing with their clients. So if you're going to not be doing it yourself, you're going to have to perhaps look to an attorney, or perhaps those select tax professionals that might be engaging in this kind of filing. But I think it's going to be, again, a mixture. So there's a couple of websites that are showing up there as far as good resources. First of all, the FinCEN, the Beneficial Ownership Information Filing site. You can keep an eye on that. And then there's a frequently asked questions site that provides a lot of good information as well. Okay, so I'm going to move on from that particular topic, but just be aware that anyone that has set up an entity through the Secretary of State is going to be required to file in 2024. So you're going to have an entire calendar year. If you've already got the entity set up, if it's going to be new in 24, you're going to have you're going to have 90 days. Okay. Next topic. This is one thing that we've been discussing, and we've talked about this on our Farm Office Live as well in the past, but we've been talking about it mainly because it's getting a lot of run in the farm press, and there's been a lot of information out there. We just want to talk a little bit about this allocation of tax basis on purchased or inherited farmland to fertilizer or nutrients. And here's just a smattering of some of the articles that have been out there, and then one from one of our colleagues, Phil Harris, that did an extensive write-up in a previous Ag Tax Issues workbook. So what are we looking at here? If taxpayers can show that fertilizer or nutrients are a separate asset that can be distinguished from the soil, they may be able to allocate a part of that purchase price or inherited value of the tax basis, in other words, of the farmland, to fertilizer or nutrients that are in the soil at the time of that purchase or inheritance. So the good analogy that we've been talking about here is that the way that we separate out a certain amount of that value of that purchased farm to underlying or existing field tile. So instead of allocating a certain amount of that tax basis to field tile, well, we may do that also to that purchased farmland. We may allocate also a certain percentage to what we're terming residual fertility. Okay, so that'll allow you to, as we mentioned here in the second bullet, that allocation allows you, the taxpayer, to deduct the cost or value of those fertilizer or nutrients instead of including that portion in the purchase price of that land, which is non-depreciable. We can't expense that part. So excess fertilizer, this amount that we allocate to field tile, we can expense that over a certain period of time. So there's a couple of Internal Revenue codes that will give us some guidance. The big one, though, is this Technical Advice Memorandum from 1992. All right, so we'll talk about that in a moment. But the taxpayer, you, are going to have the burden of proving, in the event of an audit, the existence and the fair market value of that fertility. All right, farmland owners should be aware there's no clear authority that exists here. The IRS has not been challenging these as a rule. So at least to this point, the IRS, as long as it's properly done. The IRS has not been challenging these. However, some state departments of tax have been. The Minnesota Department of Taxation is one that's been pointed out that has been looking at these and scrutinizing these allocations more than other states. Here's the technical advice memorandum, and it's from 1992. And even though it actually denies in this particular instance, the corporation from taking this kind of expense or deduction, it does then go on to lay out the terms where the taxpayer could properly amortize a certain amount of fertility or fertilizer acquired with the land and the appropriate way to do it. Okay, so we've got these four particular issues here, establishing the presence, first of all, showing the level, provide a basis on how we can measure that increase in the fertility in the land. And the last one is important, provide evidence indicating the period over which the fertility will be exhausted. Okay, so this technical advice memorandum has been around for several decades now, and it's given us some guidance and some cover, if you will, in taking this deduction. Might be considered an aggressive tax position. All right. Make sure that you're not overextending your grab for this additional deductible expense. Allocating too much to this excess fertility may get you in trouble down the road in the event of an audit. Here's the key piece, this third one. We strongly recommend, and I think this is a necessity if you're going to be doing this, hiring a certified agronomist or a certified crop advisor, and many are out there advertising their services just for this particular the strategy. Conduct a thorough soil sampling, including a report to include soil test levels, base levels, excess available nutrients, and the exhaustion period, how many years that they're considering you're going to exhaust that excess or residual amount of fertilizer, and probably above what the that kind of base level is. What is that base level going to be? That's going to get into their expertise. Okay. So that is that particular topic discussed, and we've had this discussion in the past. So if you've got questions on this, but if you're purchasing or you're inheriting farmland, you may want to consider this strategy, especially if you've got farmland that is high in fertility, high in P and K, where you can perhaps exercise this strategy and find some deductions, especially with fertilizer prices being relatively high still. Okay, the last topic that I'll just touch on here today, well, before we get into the Ohio specific issues here later on in this session, is looking at the idea of farmers qualifying for special estimated tax rules. One of the benefits of being a farmer, and we qualify farmers in this particular discussion as at least 2/3 of their gross income being generated from farming. One of the benefits that you have is that you don't have to pay estimated taxes, all right, except for one. Okay, so you can get through the entire tax year not paying estimated taxes as long as you're filing your income tax return by March 1st. You can avoid all those estimated taxes throughout the year, but you still have to qualify as a farmer. Okay, you can still pay that estimated tax in the middle of January 15th, or in this next year, I think it's January 16th of 24. That will enable you to push that filing date to April 15th. Okay, but farmers generally, if you don't pay estimated taxes quarterly, you're going to be looking at paying or filing your return by March 1st. Okay, so to qualify as a farmer, again, you have to have 2/3 of your income generated, your gross income generated from farming. What does that include? Okay, we have a list here, and you can see most of that typically comes on the Schedule F, but you can also see some gross farm income, rental income from Form 4835, some from Schedule E, gains from livestock on Form 4797. And the one that's been left out of the Farmer's Tax Guide is the gains from the sale of depreciable farm equipment reported on Form 4797. And the one that is in many cases generating a lot of gross income for farms now is the trade-in of farm equipment. Now, the Tax Cuts and Jobs Act eliminated the like-kind exchange for personal property, which includes farm equipment. So what we have for many farmers that are filing their returns, they're going to have a great deal of their income, oftentimes, especially if they're trading in new and used equipment, used equipment, they're going to have that income show up on Form 4797. So we've had, due to the fact that this last bullet has not been included in this definition of gross income for purposes of avoiding these estimated tax rules, we've had farmers that have been getting notices and even getting penalties and interest levied simply because they don't qualify under the former rules. Okay, now that we have this officially cited as a part of gross farm income, this should allow many farmers to avoid some of these love letters from the IRS coming out to you. So hopefully farmers that have, had a lot of trade-in income aren't going to continue to see these notices come out. So this is, I think, a real positive as we go forward into this next year as well. So, okay, that is going to be the end of my comments, at least in this section. And this is going to lead us to our next presenter. And Michael, you can go ahead and feel free to start sharing, and I will turn it over to you. And I'll answer some questions if I see them here in the Q&A. So.
Can you see my slides, Barry?
Yep, you're all set. You sound good.
Let's get into it. Before I get into talking about accelerated depreciation, I'm also going to talk about some key expiration dates related to the 2017 Tax and Jobs Act. That seems like only yesterday, but that did occur in December of 2017. And some of the things are sunsetting in 2025. In fact, several things are sunsetting in 2025, and I'll briefly go through that. But before I talk about accelerated depreciation, I would be remiss if I didn't say, just because you can reduce your tax liability using accelerated depreciation doesn't mean that you should. What do I mean by that? Accelerated depreciation, which is Section 179, and bonus depreciation are extremely useful tools in our toolbox to reduce income in a particular year. We have to remember that in addition to using these tools, we also have to think about the feasibility of buying machinery, or the feasibility of buying assets using the Section 179 and bonus depreciation. And so you want to make sure that you can afford to make the payments on machinery and other assets that you're using these accelerated depreciation tools on. Also, I would like to point out that there is many other tools in the toolbox in terms of either increasing income in a particular year or reducing income in a particular year. The Farmer's Tax Guide in particular talks about prepaid expenses. Those can be a very important tool, and also talks about how to properly defer income using deferred contracts. Obviously, if you're a cash basis taxpayer, which most farms and small businesses are, you can just simply hold your inventories until the next year and sell those inventories in the next year, and you have income in the next year rather than this year. And so using the cash basis method of accounting has some huge advantages for small businesses. So let's talk about depreciation. I'm going to start at the very beginning and move into accelerated depreciation. So I'll cover this relatively fast. Let me know if you have any questions. What property can be depreciated? Obviously, you must own it. It must be used in your trade or business. It must have a determinable useful life. What does that mean? Well, it has to last longer than 1 year. So does it last 5 years, 7 years? And I'll talk about asset classes here in a little bit. It must have a useful life that extends beyond 1 year you place in service. And so that's pretty obvious that you're not going to depreciate something that lasts 9 months. So when does depreciation beginning end? This is very important to keep in mind. You begin to depreciate property when you place it in service for use in your trade or business. Placed in service, when you're talking about machinery, means that the machine is on your farm. That does not mean that it's at the lot, at the machinery dealer's lot. That's not placed in service. And so placed in service means it's on your farm and ready to use. Obviously, if you're buying a planter, you're not going to use that until April, but it just simply has to be on your farm to be considered placed in service. You stop depreciating property when you have fully recovered your cost or basis, or when you retire from service, whichever happens first. And just a reminder, it's always important to keep detailed depreciation schedule that clearly indicates what type of depreciation was used, when was it placed in service, it was taken out of service, also noting that. So let's start with makers. This is your typical insurance, our typical depreciation. The depreciation we'd use if you don't use accelerated depreciation. So new farm equipment and machinery placed in service after 12/31/17 is classified as 5-year maker's property. Previously it was classified as 7-year property. Used farm equipment is still 7-year property, and all assets placed in service after 12/31/17 used 200% declining balance rather than the 150% declining balance. And so even makers, our depreciation, our regular depreciation has been accelerated with the Tax Cut and Jobs Act. And this applies to assets in 3, 5, 7, and 10-year makers recovery classes. Here's some key farm assets in their classes: autos and trucks, cattle, 5 years, new farm and machinery, 5 years, fences, grain bins, and used farm machinery, 7 years, agriculture structures, single purpose, 10 years. Agriculture structures are eligible for Section 179. Just make a note of that in case I forget it. Drainage tile is also eligible for accelerated depreciation. That's 15 years. Farm buildings are eligible for bonus depreciation, but not Section 179. They have a 20-year depreciation, 20-year useful life. There is sometimes where you don't need as much depreciation. So some years you want to use less depreciation rather than more. Maybe you have a year where income is down and you don't need to have the regular maker's depreciation, so you try to reduce that depreciation. You can do that. So you can decide to use a slower methods than the maker's depreciation. Straight line and 150% methods would be allowable. Both of these elections are made on a class by class basis each year. What that means is if you have if your new machinery is in the 5-year asset class, you'd have to decide to slow it down for all machinery in the 5-year class, or in the 5-year useful life. That's what we mean by class. And so just a note that is an option. So let's talk about Section 179 and bonus depreciation in more detail. Start with bonus depreciation. It was 100% in 22. It's 80% in 23. That's still very generous, but it is going to be reduced additional 20% all the way to 2026, and it's scheduled to end in 2026. We'll see if there's legislation that changes some of these numbers in the out years, but with the current legislation, bonus depreciation is scheduled to end in 2026. Section 179 for 2023, you can use up to $1.16 million in Section 179. That's quite a bit, but it is phased out if you make purchases over 2.89 million. It's phased out dollar for dollar above a purchase level of 2.89 million. These are indexed for inflation every year. I'm going to say it on an upcoming slide here, but typically small businesses use Section 179 extensively. There's some reasons for that. One of the reasons is you can use section 179 on a portion of the asset. That's extremely powerful in terms of trying to mitigate or manage taxes. So if you buy a $500,000 machine, you could decide to use section 179 of $100,000 on that machine. You don't have to have section 179 of $500,000 or on the entire machine. And again, that's very helpful from a tax management standpoint. Conversely, bonus depreciation is an all or nothing. And so in 2023, if I want to use bonus depreciation on an asset, it has to be 80% or nothing. And so bonus depreciation has less flexibility. Large corporations use bonus depreciation extensively, particularly if they buy a lot of equipment, because they're in the phase out region. And so if you look at your C corporation, some of your larger C corporations, they're using bonus depreciation extensively because of the phase out thresholds for section 179. So section 179 is really designed for smaller businesses. What property qualifies? Any personal property. General buildings are excluded, but single-purpose agriculture and horticulture structures are included. That's your hog finishing barn, for example, your laying hen barn. Those can be used section 179 on. It must be acquired primarily for business use. It could be new or used, and it must be acquired by purchase. So no trade-in with a section 179. Bonus depreciation, recovery period less than or equal to 20 years. And so general buildings would be included in that. Qualified property can be new or used property. The limit on section 179 deduction may be somewhat irrelevant for a lot of farms because we can use bonus depreciation on new and old property. So there is a lot of accelerated depreciation that is available to us currently, and that'll be the case all the way through at least 2025, if not into 2026. And so these are some powerful tools that'll be with us for a while. In terms of both of these, section 179 deduction, election to expense any part of a qualifying asset. I mentioned that before, and so we can elect to just use it on 10% of the value, 20% of the value, whatever works in our tax situation. And that helps immensely because it in addition to helping manage taxes, it also allows you to have more depreciation in later years. You know, you don't want to just reduce income this year. You want to look long term and try to figure out your tax management strategy long term. And so the ability to elect to expense just a portion of this is really useful. Bonus depreciation automatically applies. You have to opt out if you don't want bonus depreciation. It is on a class by class basis, so it's not asset by asset, and it is an all or nothing. So usually when I talk to audiences, farm audiences, small business audiences about accelerated depreciation, I focus on section 179. Just one quick example. This is an older example. It was used in one of the Laguda books 5 years ago or so. I've changed some of the numbers, the dates here, because it's still applicable. And we're not going to go through exactly how I did all the calculations here with a spreadsheet. You could go through those at your leisure later on. But it does illustrate the power of using section 179. So Tim Lang has $250,000 in net cash income before depreciation. His goal is to have enough depreciation to create net farm profit of $25,000. And so he kind of has recognized that he wants to shoot for a certain level of income over time. And this goal is $25,000 for Tim. Don't ask me how he got that, but he's worked with his tax preparer, and their goal is not to have zero profit. Their goal is to be in a fairly low tax bracket over a long period of time. And so his goal is $25,000. Tim's depreciation on assets acquired before 2023 is $125,000. And so that has to be deducted from the $250,000 net cash income. In addition to any depreciation on his new equipment. His equipment purchases in 2023 are $250,000, all in the same class, 5-year property. Doesn't matter what it is, it's just in the 5-year property. If he does not elect out of bonus depreciation, he will have to expense the entire $250,000, leading to a net farm loss. And yeah, I know there's income averaging and other tools available, but again, Tim has this goal of being in a fairly low tax bracket and having a fairly small profit every year on his Schedule F. Tim can elect out of bonus depreciation, elect to expense $62,500. That's what makes the math work here. His remaining basis in the new equipment before maker's depreciation is $187,500. He has a 5-year property. In addition to the Section 179 deduction of $62,500, he has a maker's depreciation of $37,500. And so lo and behold, we got to a net farm profit goal of $25,000. But what this example really illustrates is the power of being able to use a Section 179 on a specific asset and figure out the amount that you need to reach a farm profit goal like Tim. Now I'd like to switch gears here a little bit in my remaining time. I've got a few minutes left. And talk about some key expiration dates. So I'm just going to spend a couple minutes about some key expiration dates. Some of these are related more towards itemizing deductions. I think that's important to cover that because obviously farm families and other small business owners also have to fill out individual taxes. And so I'm going to go ahead and cover some of the itemized deduction things that are being phased out, in addition to some things that are very relevant for small businesses. So I'm just going to do a laundry list here in kind of the order of the section code. So IRS Section 24, the child tax credit is being phased out in 2025. When you look at these 2025 dates, most of that was part of the Tax Cut and Jobs Act that ran from 2018 to 2025. That's why there's a lot of 2025 dates on this slide. Also in 2017, the Tax Cut and Jobs Act, we increased the standard deduction. In fact, it was almost doubled, both for people filing separately and people filing married, as well as head of the household. We'll see if Congress decides to keep it where it's at, but right now this increase would be phased out in 2025. Also, part of itemizing deductions, there was a suspension of miscellaneous itemized deductions. And there's two things in there that are important for your typical small business owner that might come into play. One of the things that was in miscellaneous itemized deductions was business expenses that were not reimbursed by your company. And so if for example, if I made a trip someplace and Purdue decided not to reimburse me for certain expenses that were business related, I could have put this into miscellaneous itemized deduction. And if I had enough of those miscellaneous itemized deductions, I could have actually included those as an itemized deduction and increased my itemized deductions, and perhaps made it so I could itemize deductions rather than use a standard deduction. So that was one of them, unreimbursed business expenses. The other one was related to hobby losses. Remember that one of the things that's in the Farmer's Tax Guide that's important to take a look at is they talk about hobby loss rules. And there's several rules related to small farms, for example, that if you don't make a profit, for example, 3 out of 5 years, or you seldom make a profit, there's other factors too. But if you seldom make a profit, or it looks like you usually have losses, and you also don't meet the qualifications for some of these other factors, your business is going to be deemed a hobby rather than an actual farm or business. And in the past, before 2018, before the Tax Cut and Jobs Act, some of those hobby expenses could be deducted as miscellaneous itemized deductions. Those were suspended. And so it's unreimbursed business expenses and some hobby expenses were in that miscellaneous itemized deduction, and those were suspended through 2025. Also, there was a suspension of deduction for personal exemptions. When we increased the standard deduction, we suspended the deduction for personal exemptions. That sunsets in 2025. Also, there was a limitation on deduction for state and local taxes and property taxes of $10,000. Again, Congress will have to take another look at that and see if they want to keep that in place or increase that deduction past 2025. Also, personal casualty losses were limited to a federally declared disaster area. And so unless you're in a federally declared disaster area, you could not have personal casualty losses. And personal casualty losses are an itemized deduction. And so if you can't have a personal casualty loss, if you have a loss and it doesn't qualify, that reduces your potential itemized deductions. Some that are more closely related to small businesses. David's already talked about the increase in state and tax exemptions. In 2026, that drops down to 5 million plus some inflation adjustments. That's a big drop downward. So we'll see what Congress does in meanwhile to address that issue, if anything. Also, additional first-year depreciation was added to the Tax Cut and Jobs Act. We've had that off and on for years, and so I don't expect that to necessarily go to zero. It's scheduled to go to zero past 2026, but I think Congress will probably have some legislation before that and keep that with us. But it's scheduled to sunset in 2026 looking at the current IRS code. Also, something that we're not going to talk about today, but something that's been very important for small businesses is the qualified business income deduction. This is essentially a 20% deduction on qualified business income, which 20%, if you think about that, that's a very large deduction. It's larger than a lot of other expenses we have in small businesses, including farms. And so that's a big one. And I have no idea what Congress is going to do with that one, but it is set to expire in 2025. With that, I'll just leave you with my website. My contact information is on the website. We have all kinds of publications related to not only tax management, but also finance, leasing, transition planning, and other topics. So I will turn it back over to Barry.
I'm actually going to take over. Thank you, Michael. Really appreciate it. A lot of great information there. I'm going to take over and start talking about Form 1099-K reporting changes. And you might be asking yourself, well, what is a 1099-K? And a 1099-K is a report of payments that you got for goods or services sold during the year. And these reports come from two different types of entities. You have your credit card, debit card, and gift card companies. And then the second type of entity that we're going to focus on today are your payment apps or online marketplaces like Venmo, Cash App, PayPal, things of those nature. They're also called third-party networks or third-party settlement organizations. And so, as I just said, these reports are for payments that you receive for doing business, right? So what about those of us that use Venmo or PayPal for personal reimbursements, right? So for example, I purchase a set of concert tickets for me and my friends, and they reimburse me on those tickets. Well, those payments should not be reported on a 1099-K. But you have to ask yourself, will Venmo or Cash App really differentiate between family and friend payments and payments for the sale of a good or service? And how easy is it for someone that is doing business to say, oh, no, everything I've done has been a personal expense. It's just reimbursement from friends and family. So in, Venmo, Cash App, PayPal, they're going to cover their legal obligations by just sending these 1099-Ks out to all individuals probably that had some sort of transaction on their platform. And the reason that we're talking about this, as you'll see here, these third-party networks, they are required to issue a Form 1099-K for any gross payment amount in the excess of the amounts listed. So for 2023, that's going to be $20,000. It reduces down to $5,000 next year, and then it goes down to $600 starting in 2025. And when you receive these 1099-Ks, you as a taxpayer need to report or should report these on your tax return. Now, some of the changes that have happened is that $600 was actually in effect for 2023 up until a few weeks ago. So for a few weeks ago, the IRS came out and decided to delay the $600 reporting threshold to give taxpayers more time to prepare and transition for these new reporting requirements. But we don't know what's going to happen between now and then. All right, so we're at the point now where if you're not $20,000 over on Venmo, then you're probably not going to get a 1099K. But that's if we live in a perfect world. Who knows if these Venmo, PayPal, their software was already configured for a $600 threshold, and are they going to report these 1099Ks regardless of this $20,000 threshold? Well, that's what happens when you receive a 1099K in error. And the first thing and most important thing to remember is if you do get a 1099K and you believe it's an error, just don't ignore it. The IRS will be looking for these payments on your tax return. So what do you do if it is an error? Well, first thing you should do is ask the Venmo, PayPal, Cash App, hey, this is a 1099K sent an error. Can you send me a corrected one? You know, whether it's I never conducted business, this is all family and friends, personal reimbursement. Again, that might not result in a corrected 1099K. So the IRS has come out and given instructions if you cannot get a corrected Form 1099K. And so the IRS has instructed us that if you do get a 1099K in error, you enter that 1099K on Part 1 of your tax return, line 8Z, with the notation Form 1099K received an error, and you insert the amount. So now that's going to say, okay, you did receive payment, you received income on this 1099K, but then on Part 2, line 24Z, you go in with the same notation and that backs it out, that adjusts it, reduces that income from that 1099K, but at least the IRS sees that you have it on your tax return. So like I said before, this is where we're at right now. The $600 reporting threshold doesn't go into effect until 2025 as of now. Like I said, things could change and you still might be seeing some 1099Ks being issued to you in error just because we don't know whether or not the software is adapted quickly enough to the IRS's changes. All right, the next thing I want to talk to you about is this tax scheme that's been on the IRS's Dirty Dozen list and regarding charitable remainder trusts. And a charitable remainder trust is an irrevocable trust that lets you donate assets to charity, but also lets you draw annual income for life or for a specific period of time. It's important to note here that the trusts are irrevocable. So once the assets go in, they can't be taken back out normally. So I want to go over how does a charitable remainder trust work normally, because then I want to show you how this tax scheme is working. And these tax schemes are being promoted by advisors and shady promoters that are trying to sell this product to farmers and say, hey, we can reduce or eliminate your tax liability by using this product, which simply is just not true. So in a charitable remainder trust, and there are multiple types, but this is a very high level overview of what charitable remainder trusts are. So it works by the donor transfers property, cash, or other assets like grain or machinery into an irrevocable trust. By transferring the asset, the donor might actually qualify for a charitable contribution deduction. And it's also important to remember as we go over how does the scheme work, the basis of the asset is a carryover basis. So whatever the basis is in the hands of the donor is the basis that the trust receives in that asset. So for example, if you donate grain to a charitable remainder trust, the donor's cost basis in that grain is $0. The trust also receives a $0 basis in that grain. Now, if that grain is sold for $100,000, they do not get a step up in basis. It's important to remember that. Second, the trust will then take those assets, the grain, machinery, property, and invest and sell that and invest it into something like an annuity, which will then help pay the income to at least one living beneficiary for a specified payment term. Now, this payment term can be the life of a beneficiary, or it can be from anywhere between 2 and 20 years. These payments, however, and this is where it's getting sold, these payments to the beneficiaries are taxable income. There are 4 categories or 4 levels of how these distributions from the trust are taxed. The first 3 are ordinary income, capital gains income, other income, and then the last one is a non-taxable distribution of the corpus of the trust. And so you're going to go through those 3 levels first before you get to the non-taxable parts. So it's important to know that with charitable remainder trusts, most of the time tax can be deferred but not avoided. And then lastly, at the end of the payment term, the remainder of the trust passes to some qualified U.S. charity, and there has to be at least 10% of the fair market value of all property placed in that trust has to be transferred to a charity at the end of the specified payment term. So now that I've given a very high-level overview of how it works, these are some of the reasons that you would want to create a charitable remainder trust. You know, you have a charitable purpose, and you plan to make major donations, and it also provides you some tax benefits with those charitable donations. You provide predictable income for life or over a specific period of time. It also allows you to defer income taxes on the sale of assets rather than recognizing the tax liability if you were to sell that asset all at once. As I stated before, promoters and advisors that are selling this product, according to the IRS, some of these not so above the line promoters and advisors are saying to clients, hey, we can eliminate your tax liability, and we have this beautiful product that you donate your land to, we sell it, we provide you income for life, and you don't have to take tax out on it. There's no tax on it. So this is what the scheme looks like. Property with a fair market value greater than the donor's basis is usually transferred to the trust. I'm going to use the example of grain again, which has a $0 basis when transferred by the donor to the trust. And then the trust will decide to take a step up in basis when they sell that grain. So again, if they sell that grain for $100,000, the trust then will claim, oh, we have a $100,000 basis in that asset, which is not true. And then the trust will sell the property, but does not recognize any gain because they took up that step up in basis. And then by misapplying the tax code, the beneficiary retreats all the distributions or payments from the trust as excluded from tax. And these products are being sold to unassuming individuals. There's a couple tax law case or tax court cases out there regarding farmers that donated crops or machinery and are taking the distributions as non-taxable income. And then they are hit with a tax bill of hundreds of thousands of dollars, and good luck finding the promoter or the advisor that sold you this product, and where they are now will never be seen, but the taxpayer is still going to be held liable for the unjust enrichment. So the moral of the story is make sure you are working with a trusted tax professional or attorney when creating a charitable remainder trust. And if it sounds too good to be true, it probably is. So ask questions. And with that, I think we head into our Ohio tax update.
All right. Thank you so much, Jeff. Some great updates there and some things to look out for. So it seems like whenever there is the possibility of income tax to be saved, there will be schemes out there targeting certain taxpayer populations. So be on the lookout. Is if things look too good to be true with some of these tax strategies, they likely are. Okay, so now we're going to move into, and with apologies to our Indiana colleagues and others that may join us from other states, we're going to talk about some Ohio specific things here in the next 15 to 20 minutes. Okay, the first thing is not income tax, and we're going to go into the world of property taxation issues and current ag use valuations. And many of you are already well aware of what's going on in this particular area for this year and into next. The one thing that I want to point out is that we have a kind of a staggered schedule of either reappraisal or updating. And the counties highlighted in purple are the counties that have been updated or reappraised in 2023. And we'll see then the subsequent property tax increases this next year. So 41 of the 88 counties, this is the big year. And they're all reliant on, and we, as all of us are, on the CAUV formula. The CAUV formula is the net income method appraisal approach that's used to determine farmland valuation for property tax purposes in the state of Ohio. And many other states have very similar kinds of income method approach to valuing farmland rather than the market approach. So how does that work? Well, the valuation, this net income method of capitalization approach looks at this formula. And here's the simplified formula using gross income, which is determined by price and yield. And then we subtract total non-land production costs, most of which they do source from our enterprise budgets at the Ohio State University. And they divide that net income by a base cap rate or interest rate that's somewhat similar to another basket of goods that you might consider as a similar holding period and risk profile. So that is the base formula in a very quick and, well, too quick of a process of explaining that. If you want more information, we can provide that for you. But here's the big issue for this year, and it's sticker shock more than anything, because what we see in all these counties is you only get reappraised or updated every 3 years. So you take 3 years worth of perhaps increases or decreases all in that 1 year period. So we look back to the last time the counties in purple were reappraised or updated, and the average value, you can see I'm circling and or pointing to it down here for all of the soils. And the Ohio Department of Taxation tracks over 3,500 soils, but the average of those was $668 per acre. And that was then the basis that the local county auditors used to apply the millage against to determine property taxes on those acres of farmland. Now, fast forward now to 2023, the formula, due to the factors that I'll go over here in just a moment, are indicating that we're looking at an average value of $1,443 per acre. So it's going to be a big jump in values across Ohio. So the values, all the variables that go into it are kind of working against the, I guess, holding of the property or the valuation of farmland. So these variables are leading to these increases in the values that we're seeing in this 2023 year. We go back and look at the last time we were looking at the variables, the crop yields that go into the gross income component of the CAUV formula. We're looking at just the 3 primary row crops in this particular formula: corn, soybeans, and wheat. Over that, they look at a 10-year period, the 2010 through 2019 period. Those were the average values, the average yields. We go forward into the 2013 to 2022 period, and you can see how those yields have increased, and that's an important component in driving this CAUV value. The other thing is price. It's important that we recognize that in the price component, we're looking at a 7-year Olympic average. So we throw out the high and the low. But if we look at the overall numbers compared to where they were in the last 3 years ago in that particular update or reappraisal period compared to where we are now in 2023, you can see the prices have increased. So we have those higher yields, the higher crop prices. We do have higher non-land production costs, but the increase in percentage, not quite to the level of the gross income. And what we still have working in this formula is still low interest rates. We don't have the benefit of having these, the newer data included yet. But as that cap rate or these interest rates work their way higher, that will help to decrease CAUV values again. They just haven't worked their way into the formula in a sufficient numbers yet. Okay, so here's the comparison. The blue bars across this particular table are the CAUV values for Ohio from 2006 to 2022. This is compared then to the red bar graph as you go and look across here. This is the USDA average value of cropland in Ohio. So you can see that the CAUV formula is doing what it was intended and working out a use value rather than a market value. And it is doing its job. However, we're still going to see some increases and some sticker shock for many farmland owners across Ohio in 24 when we look at property taxes. This is just looking at some additional variables. This is looking at the cost profile in the last update compared to this particular one. Now, I mentioned that the Ohio Department of Taxation tracks 3,500 soils, and they allocate this particular value across those different soil profiles. The higher productivity index soils, this 100 plus, you can see they're valued at higher amounts because they're going to typically generate higher net incomes. As we look at the 2020 period, the $2,820 per acre compared to this particular update in $4,430. So you can see the higher productivity soils valued higher and taxed at a little bit higher rate. Then as we apply that millage to that particular higher valuation, all the way down to the lowest productivity soils. But on average, the numbers that I related earlier, 668 versus 1,443, significant increase. So it's going to be a big increase in change in property tax values for most soils across Ohio, those 41 counties. And lastly, we've been tracking and looking at some legislation. The Ohio legislature has been looking at some ways to perhaps mitigate some of this big increase in CAUV values. But in the end, it looks like most of that legislation didn't gain a lot of traction, not enough traction to do what they intentionally set out to do, and that's to look at maybe averaging the last 3 years instead of just taking the value for this generated for this particular tax year. So I think what we're seeing is that we're basically stuck with the values that were generated this year based on the formula. There was a lot of pushback from different, the Ohio Auditors Association and certain other entities for these changes that the legislature was considering. So, okay, with that, I'm going to turn it back over to David. So, David, it's all yours.
Yeah, definitely. CAUV is something that all of our farmers and landowners in the state are really watching, Barry. So our farm office team is going to keep looking at this, and I'm sure we roll into our January, February, March editions of this, we'll be talking about it. So this is something that I wanted to briefly talk about. We discussed this the past year, but want to make sure that it's out on everybody's radar about the Ohio Beginner Farmer Tax Credit Program. And this goes back to Ohio House Bill 95, which was titled the Beginner Farmer Tax Credit Bill. And that was passed back in August of 2022, which is grants a 3.99%, so just under 4% tax credit to landowners who sell or lease assets. So that could be machinery, equipment, it could be land, it could be livestock, those assets to a certified Ohio beginner farmer. So this was passed and it's rolled out here in this past year in 2023. I mentioned our farm office team and Peggy Hall wrote a great law bulletin on this program, which can be found on farmoffice.osu.edu under our law library. And it talks about this income tax program. But basically, as part of this, the beginner farmer has to complete. So the landlord, the senior generation is then going to sell, and again, encouraging our new beginning farmers to get into the business to help them overcome some of the inherent barriers of that. Part of this is the new or beginner farmer needs to pass the farm financial management course. Just wanted to share with you quickly, Ohio State has a 4-pronged approach that's been approved a year ago at this time on courses that these beginner farmers could take to meet this requirement. And the first one, which has been very successful, we've had a lot of people enroll in this program over the past year, and that's our Farm On Financial Management course. It's on demand, self-paced, it's virtual. So you can do it right from the comfort of your home, and it's just like having a college class because there's resuscitation sessions that Eric conducts every Monday for the folks that are enrolled in the class. There are homework assignments, there are activities that have to be done and assignments to be able to pass the course, but that's completely online. And then we have a beginner and small farmer colleges, which are regional in-person programs, which seems like most of them are being held over 4 nights. There are a couple programs that are going to do 2 Saturdays, but those are going to be offered around the state. Now, right now, there's one that is currently in session down in Claremont and Brown counties. But as we move into 2024, there'll be more of these regional programs that will be offered around all parts of Ohio. And Barry teaches a class, AEDE 3104, which is a farm business management class for undergraduates. So those folks that are enrolled at the Ohio State University can attend and take the AED 3104 through Barry, or for those folks that are on our ATI campus up in Worcester, there is an animal science course, a farm business management course that Royce Thornton is the instructor of record on that they can take as well. And then the beginner farmer can receive a tax credit basically for the cost of the course. So there's different price points for a course. You can imagine a college course is a different price point than the Farm On course, which is a $300 course. But that cost of that course, the beginner farmer can receive a tax credit on the Ohio income tax for a tax credit. And there's our Farm On course, just as a plug, and it's on the Scarlet Canvas platform. I should mention that not only does it qualify for this program, but it also qualifies for the USDA Farm Service Agency's Beginner Farmer and Ranch Loan Program. We've been approved as a vendor for that as well. And again, that's an exceptional online course that people can take from the comfort of their home. And if you want more information, just go to go.osu.edu/farm-on. And should mention that we are so grateful to the Ohio Corn and Wheat Association, as well as the Ohio Soybean Association, for helping to come along as sponsors to help us develop that course. So we appreciate both of those organizations for doing that for us and with us. And here's the Farm On modules. Again, the 10 modules that are there. We go through a lot of activities and worksheets as well as the videos and information that's part of that. And here's basically what happens after the beginner farmer completes the course. They get a certificate, which proves they have passed the course, and they're able to submit that certificate to the Ohio Department of Agriculture through the Beginner Farmer Program and through an app. And then they will negotiate work for a purchase or a lease agreement on those farm assets that we mentioned. And then the senior farmer then submits the beginner farmer name, that's a copy of that certificate, and their purchase or lease agreement. And they submit that on with an asset transfer application to the Ohio Department of Agriculture. And once all that paperwork has cleared, the Department of Ag then passes on the 2 entities' names to the Department of Taxation so that we can have the proper tax paper trail for that credit to occur. So if you want more information about this program, Again, our friends at the Department of Agriculture have a complete website there, and there's you can hit the hot link when you download the slides and go right to it so you can get more information. And just a screenshot of what it looks like when you get to the Department of Ag. And again, that's just agra.ohio.gov is the main portal. And then you'll go through the Farmland Preservation Office to ultimately get to the Beginning Farmer Tax Credit Program. And then all the applications are online, just a screenshot, a little closer screenshot. And these are all PDF writable type of documents that the beginner farmer and then the farmer that is going to transfer those assets and machinery to the next generation, all PDF writable documents that document the process to work you through it. And there's the Beginning Farmer Asset Transfer Tax Credit Program for the senior producer that's going to do that transfer to that newer beginner farmer. So we have that information. If you want more information on this program, don't hesitate to reach out to Eric Reeker. Eric is our record of instructor. He's kind of leading our team for that. But we've talked about it before, but we wanted just to make sure that if you haven't taken advantage of that program here in 2023, that may be something that you're going to be able to do here as we move to the new year. So with that, I'm going to turn it back to, I believe, Jeff, right?
That's right.
Jeff, and I will say there's a couple little reminders on there that just popped up that you need to snooze for whatever reason.
Oh,
There you go.
there we go.
Awesome. All right.
Thank you. I'm going to dive right in here to some more Ohio updates, specifically on the commercial activity tax. So there were new laws passed in the biennial budget this past July that affect the commercial activity tax and whether or not you will have to pay it anymore. But for everything, if you've been paying commercial activity tax, everything for 2023, all taxable gross receipts earned in 2023, everything remains the same. So you will still be filing next May for all those taxable gross receipts earned in 2023. But starting in 2024, those businesses may exclude the first $3 million of taxable gross receipts. And then in 2025, businesses may exclude the first $6 million of taxable gross receipts. So there's been an estimate that about 90% of Ohio businesses will no longer be required to pay commercial activity tax. And so for those businesses that this will be their last year filing in May, there is allegedly the form when you file this year, there is a box that you check, and make sure you check with your tax professional when you do this. But there's a box that will allow you to close out your account effective December 31st, 2023. That way you will no longer be required to file for your 2024 taxable gross receipts. So just make sure you check with your tax professional and say, hey, I want to close out my account, but you still will be required to file everything for your 2023 taxable gross receipts. Some other things that the law did is it eliminated the annual minimum tax for commercial activity tax, and all taxpayers will be required to file quarterly starting in 2024. Another interesting update, the Ohio Supreme Court recently came out with a decision in this Stingray Pressure Pumping LLC versus Harris. And the issue in front of the Supreme Court was when does the Ohio sales tax exemption apply for equipment used in oil and gas production? And so Stingray Pressure Pumping bought all of this equipment here. I'm not going to pretend to know what any of it does, but Stingray claimed that all of this equipment should be sales tax exempt. Well, the sales tax or the tax commissioner just concluded that fracking equipment was not used directly in the extraction of oil and gas and therefore did not qualify for the sales tax exemption. And Stingray appealed the case all the way eventually to the Ohio Supreme Court. And the Ohio Supreme Court did say all of that equipment except the data van is used in unison to expose the oil and gas, and therefore it is used directly in the production of oil and gas. So what this does, it kind of expands the definition of directly used, and we wonder how that will apply to other sales tax exemption areas, for example, in agriculture. equipment that is used in unison to produce an agricultural product, is that now going to be sales tax exempt? Well, one of the ripple effects that might have come from this decision, actually, there's new legislation, House Bill 347, was just introduced, and it creates a presumption that the purchase of a trailer, utility vehicle, APV, and compact tractor is exempt from sales tax if the person claiming the exemption provides the vendor with 3 years of Schedule F. So this might be one of those areas where now that ATV or that compact tractor, you know, they're used in unison, maybe not directly on it, but used in unison enough to where now we're saying, okay, they're sales tax exempt as well. But one of the best parts about this, I thought most interesting about this case, is that the court broke from stare decisis, or long-standing precedent, and it issued an opinion on how Ohio courts should interpret tax law moving forward. And the Ohio Supreme Court recognized that in the past, Ohio courts have interpreted tax exemptions against the taxpayer, meaning that Ohio courts have always favored tax collection. Well, the Ohio Supreme Court says now Ohio courts will apply the same rules of construction to tax statutes that applies to all other statutes without a slant to one side or the other. One could argue that this should have been the policy from the get-go, but whether or not you disagree or agree with that stance, the court has now said it is not the court's responsibility to make tax policy, but to provide a fair reading of what the legislature has enacted. So there is the Ohio Supreme Court opinion. I have included it in your slides if you want to read it. It's a really good read. And then one last update from me here. Robert Moore, myself, and Samantha Cabaldo from the National Ag Law Center are actually hosting a webinar next month, January 11th, from 7 to 9 p.m. on farm insurance. And my background is in insurance defense before I came to Ohio State, and Sam, she was an insurance agent before she became an attorney. And so we're just going to give an update on the practical side of insurance and how it can help benefit you in your farm operation. And you can register at farmoffice.osu.edu/farm insurance. And with that, I think that concludes our presentation today.
Well, I think it does. Thank you, Jeff. And I want to thank David and Michael. And I think well, hopefully we covered some material that was helpful to all of you. We've answered some questions. I don't think we have any more to answer. So we did drop a link in there as far as the evaluation, although I don't think the way you dropped it is clickable.
Yeah, I'm trying to figure out why it won't do that, Barry.
Okay, but
there it is.
okay, there it is. So thank you. We'll take your comments and thoughts. We do value those. It helps us to well, make our next presentations better and focus on the things that most interest you. So Michael, I'll give you a chance to say some last words.
I don't have any last words of wisdom. I hope everybody has restful holidays.
Agreed. Okay, and with that, we'll sign off, everyone. We thank you for joining us, and we hope to see you at a future Farm Office Live, whatever state you might be in. Thank you all.